Okay, let's start out with the most basic kind of option trading that you can possibly imagine, and that's the purchase of a single put. And it's quite easy once you get used to technical analysis, employing a simple put buying strategy to profit from the market's decline. Now, we talked about how we analyze the market to determine when volatility is entering the market. But it's just as important to understand when you think the market is going to decline. In front of you is the spiders. It's the S&P 500 ETF, one of the most popular traded ETFs on the planet. And one of the things I want to point out to you, a very, very simple technical analysis trick that I use, which is quite easy to do, and it turns out to be probably one of the most reliable technical studies possible that you could do to determine future market direction. It doesn't always work, but it's pretty good. I'd say 90% of the time it's going to give you a fairly accurate reading on the market's future potential to either go into rally mode or to go into declining mode. And that is the combination of price and volume. Here's what I mean by that. If we go back to August, this is in 2010, September-August period, you notice that the market started to go into a pretty extensive rally here. What was interesting during that time period is that most of the red bars, the time in which the market started to decline, the selling volume was higher than the declining volume. So there's a couple of periods here in which the market was rallying, but you see these large red spikes here showing that in fact the market was declining on heavier volume. And then when it started to go back up again, it increased on relatively lighter volume on the advances. As we got closer to the summit, and you can see that it was just an amazing rally actually from about the 101 level all the way up to about 135. Volume on the way up was relatively light, but look what also was occurring. In our discussion of volatility, you can see that the bars were relatively short, and they weren't wide-ranging bars. On a daily chart like this, the range was pretty small until we got up into here, and then even the days in which the market rallied, the bars started to widen out. You could probably get some idea that some volatility was coming into the market, and the market was ready to start declining. During that time period, volume increased. So you begin to take note of that, but you don't go short yet and you don't buy any puts at this point, because it's important to understand that even though volume was coming into the market on the downside, those bars didn't really move very much. So there was no real ease of movement, and that's what I want you to think about, is ease of movement with the market. The market was easy to move higher on relatively light buying volume, but then at the same time, the selling volume, even though it was heavier, didn't produce a lot of significant results. In other words, the market did not decline significantly on this higher volume. As the market continued to go higher, so it's a caution flag, but it's not necessarily a point at which you want to go short. As the market continued to go higher, all of a sudden we get a couple of days in which we get this big, wide-ranging day on high volume. And that's the point where you say, okay, there wasn't enough buying to absorb that selling, and it was fairly easy for the market to move down in a significant way. And that's where I'd start to pay attention. Right in there, I'd see this high volume spike to the downside. I saw this huge bar coming down to the downside. Let's zoom in a little bit here, and that's what we see. So we've got this very large ranging bar, a wide ranging bar with higher volume right here. So I start to pay attention to that. Now, as the market continues to go higher, of course, we've got a couple interesting things here. The market does actually start to decline significantly, and it falls from about the 133 level down to 123, a fairly decent move, and on much higher volume as it hits this potential bottom. That's also a sign that maybe there's some capitulation selling, and the market is actually done selling at this point and done at this point in time. Another thing that you can do which is very easy to do, is simply take your graphic tools, which most trading platforms have, and start to look at a measure of the highest declining volume, and then kind of measure that as you go along. And you take a look at all of these red bars here and draw a line, so you can see that as the market declined, and I draw a line down here, as the market declined, the volume increased. And that's a sign that there's some selling coming into the market at this point, but it hasn't really reached, it just gives you a forewarning that in fact there is some heavy selling coming into the market. Now, this is also crucial. When you do see some heavy selling coming into the market, both in terms of volume and in price decline, you want to look at the rallies. On the rallies, volume actually declined. So we have a period in which the market rallied, and then we have a period in which the volume also declined on the rally. And we continue to see that type of pattern. We see the market declining here, and we see at the same time the volume increasing, mostly red bars